Breon here with TRG Financial, here to play a bit of a Monday morning quarterback based on the Super Bowl. Millions of you were focused on the game. Congrats to the Seahawks, monitoring point spreads, monitoring who would score the first touchdown. I'm sure there was a lot going on. But as an advisor, I'm really looking at a different set of numbers. Did you realize that this weekend alone, Americans spent enough money to buy a small country? I'm going to say that again. Spent enough money to buy a small country. We call that the Super Bowl economy. It's really not just a game. It could also give you some insights on how your portfolio may actually work. So what I want to do today, just briefly spend a few minutes with you, is talk to you about how the big game can maybe look at your long-term strategy in your markets. So first, let's talk about GDP engine. This year alone, it shows that about $20.2 billion will be spent over the last weekend. That averages roughly to about $95 per person. And we're talking about everything from food, apparel, and electronics all in a single weekend. And that's a real world example of how we can look at the velocity of money. In a consumer-driven economy like ours, if you consider roughly about 70% of our GDP is based on consumerism, the value of everything grows when those dollars exchange hands. So let's consider this. I'm sure you maybe bought some wings, okay? You might have bought a new TV. You may have paid a delivery driver to come bring you those wings. You may have paid someone to hang that TV. All of that was money that was spent going towards this weekend. And it's really a good test for how the American consumer, providing that even when we've got complex situations right now, that we still have the will to spend, and that remains one of the primary heartbeats of the market. So as we consider what's going on, there's some folklore that I would like to demystify as well. If you've been following along for a while, there's some betting sites and some marking sites out there that would tell you, hey, that the Super Bowl is an indicator of what may happen in the financial markets. So the idea is first, and it's a kooky one, but the idea first is that if a team from the NFC wins, that the market will go up for the year. And if a team from the AFC wins, that the market will go down. Now, wildly enough, historically, this superstition has actually been right about 70% of the time. But here's the deal. If we really talk about it in plain English, that is a total coincidence. In 2026, we don't invest based on luck or considering what's happening with the game. We really look at those fundamentals, what's happening there, interest rates, corporate earnings, technology innovation, not based on what jersey is holding the trophy at the end of the year. Again, congrats to the Seahawks, but I don't think any of me or my clients will be sitting down talking about, well, the NFC won this year. We need to be placing our dollars in this place. Always consider your strategy, think long-term in that asset. So where's the real impact for investors and what we're here for today? And let's look at some of the game day sectors. You've got consumer staples. Think the big beverage companies, big snack companies. They're always going to see a massive one-day spike. A couple weekends, people are going to be buying things to make sure that they're prepared for the game. We can also look at ad tech, the companies that are buying those whopping 30 one-minute spots for almost up to $8 million this year. The real winners aren't just the companies that are buying the ads, but also the platforms and the data firms that get those dollars that the ads are spent on. So whether you actually move the needle with those ads, there's still the velocity of money happening, exchanging hands, being spent in one place, and then potentially also getting consumers in another. But I do want to get a quick word of caution because I'm not giving any financial advice here, because we're not saying we're going to buy a stock just because we saw a commercial or invest in some mutual fund. As an advisor, we're always looking for some sustained momentum. It may be a spark. We saw some things that might have us go do some additional research. But again, we're investing in companies and investing in groups that not only fuel the economy overall, but also we're looking at some of the underlying details to make sure that just because they had a spike during a big game doesn't mean that that'll be sustainable. So what's the takeaway for your portfolio? Why am I talking about the big game? We just want to use this weekend as a reminder that your consumption also could impact your holdings. Again, roughly 70% of the US GDP is based on people buying things. So your portfolio likely relies on the same consumers seeing the strengths of what happened on yesterday as well as what may happen tomorrow. So our goal again is to stay disciplined. We're going to ignore some stupid superstitions. And of course, we all enjoyed the game. Hopefully y'all are back at work today too. I know some people take some time off right after the game on that Monday. But regardless of what happens at TRG, of course, our goal is to tend to those assets. We want to rise those assets and we want to grow those assets. So if you're back in the office, I appreciate you checking this out on a Monday. Drop a note in the comments and we'll talk soon.